Ekse, Fede, what's up guys? My name's Ofentse Tshilo, aka WeezyTheTrader. So guys, I just want to have a chat with you guys about trading. I want to share a few trading concepts that I've learned along my journey and things that I'd like for you guys to go through and look at when you start trading. And the first thing, what is Forex? What is Forex? Other people call it FX, other people call it the foreign exchange market. You can call it the foreign exchange market in full, or you can have the acronym FX, or just call it Forex in general, or Forex trading. It's totally up to you. Forex is the world's largest market. It usually is open for 24 hours a day, and it usually starts from 5 p.m. on a Sunday afternoon all the way to a Friday at 5 p.m. This is for South African traders. This is basically for South African traders. I'm talking to South African traders. I don't know about other continents, how and when they open, but the one thing I've noticed is that markets usually on a Monday, they'll be open Monday morning, 12 a.m. They'll be open, and then you can scope through the charts and then see exactly what it is that you're looking for, and the currency pairs, the indices, and so on. So now that you've developed a plan for trading, now you understand when the market's open, you can trade all your currency pairs and your indices from the Monday all the way to a Friday evening. You know, the last the time when the market's closed on a Friday. I know it's 10 o'clock. That's when everything just ceases. And then Saturday you'll have your volatility 75. I don't know what those are. The other indices or something, but I read about it somewhere, so I'm just mumbo jumboing. Sorry guys. Now the one thing that I want us to have a look at is your trading instrument. Now one of the trading instruments that I want us to have a look at is your currency pairs and your indices. Now, okay, I'm not going to talk about indices. I'll just name a few that I know. But currency pairs, they basically look like this. They look like this. And the first one that you'll see is your Euro USD. And then, it basically looks like this. This is what a currency pair looks like. So the first currency, which is the Euro, is listed as the base currency. Then the second currency is called the quote currency, or it can be called a terms currency, or just bet. So that is what a currency pair looks like. Now I just defined it for you, and I hope that now you understand which one is the base and which one is the terms or the quote. So the first one is the base, the second one is the quote or the terms currency. Now when you trade, you need to know your currencies. You need to know the currencies that you can trade. And the very first currency that I'd like to talk about is the US dollar. Now the US dollar is most commonly traded currency in the Forex market, and it is also considered to be the world's reserve currency. Like now I just explained in the currency pair, you saw USD is a base, is a quote currency or a terms currency. You see it is the US dollar and the euro currency. So yeah, I'm just mumbo jumboing, but please bear with me. Then the second currency that we're gonna have a look at is the euro. Now the euro is the official currency of the European Union, and it was first launched in 1999. The exchange rate of the euro against the dollar is determined by the European Central Bank, also known as the ECB, which sets interest rates and the monetary policy for central banks in member countries. We just talked about the US dollar and the euro, and that's basically just my favorite currency pair to trade. The other one is the Great British Pound, the one that's my favorite one. But we'll talk about that after I discuss all the currencies. So the third currency that we're gonna have a look at is the Japanese yen. The Japanese yen is the second most actively traded currency in the forex market. Excuse me. The Japanese yen is considered a safe haven currency due to its relationship to gold. So I'm assuming, you should be assuming that now, currency, the Japanese yen is very close to the gold. And, people like to save their money or buy gold for, to replace their currency or to save their money through gold. The fourth currency that we're going to have a look at is the British pound. Now, the pound is the official currency of the United Kingdom and Northern Ireland, as well as its dependent territories. It's also one of the most closely followed currencies on the forex market. The pound has been tied to gold since 1816, and it was originally pegged to the value of silver in 1717. I read this off of Google, guys, so just sharing with you. Then the fifth currency pair is the Swiss franc. The Swiss franc is one of the most actively traded currencies on the forex market, and it is also considered a safe haven currency. If you've seen in the movies, you'll see people saying, "No, I have an offshore account." And in the Swiss, I'm assuming Swiss, these guys, they have money. This currency is people in movies, or general people like millionaires. They'll save their currency, or they'll create a Swiss franc account, and then you wonder, why are they doing such? Well, the Swiss franc it's been linked to gold since 1850. So you wonder why? Because when you're saving your money there, you're gonna be gaining interest, and the fact that it's been linked to gold since 1850, these people have to be making money off the interest that they're gaining in these bank accounts. So you can maybe consider opening a Swiss franc account, and then over the years, then you take out your monies, and then there'll be a lot. So it's totally up to you. Now, the sixth currency that we're going to have a look at is the Canadian dollar. Now, the Canadian dollar is one of the most stable currencies in the world. It's also used as a reserve currency, and one of Canada's main exports is its financial system. Now, I don't know if you've heard, but Canada is a very safe place. Like, you could even leave your car outside. You can even drop money just there. I don't think they'll take it. People are not greedy. The same as Dubai, Abu Dhabi, those places. So, drop at 20 rand. 20 seconds later, it's gone, China. It's gone. Forget. They won't even bring it back. Zama. Hey, these guys, they'll take your money. Now, the seventh currency pair, the seventh currency that we're going to have a look at is the Australian dollar. The Australian dollar is one of the most stable currencies in the world. It's also been tied to gold since 1851. So you can also consider opening an Australian dollar bank account. That's if you want to go to Australia. Totally up to you. Now, each of these currencies, they have their own unique characteristics, and they are affected by different economic factors. Now, I'm probably sure you're asking yourself, now, Ofentse, you've given me all these currencies, different currencies, 7 different currencies that we can trade. Now, which one should I trade? Now, this will depend on a few factors, mainly your trading style and the amount of capital that you have available for trading, how much money you have, and what kind of trading model that you're gonna choose to use when you start trading. So it's totally up to you what kind of trading model that you want to use. And these currencies, like I just explained, they will depend on the kind of capital that you have. Maybe you have 200 rand or $200. It's totally up to you, and your trading model, it will depend. So yeah, Now, before we even start, there's a few trading concepts that I want you guys to take note of. I'm going to be sharing them with you guys: pips, spreads, margins, free margins, charts, candlesticks, and time zones, and so on. So I'm going to ask you guys to please pay attention so you can be able to understand the things that I'm going to be going through, because I have my notes here, and I'm just going to be sharing with you guys exactly how to understand these things and what I'm trying to say. So basically, right here we have a pip, also known as the price interest point. A pip is short for price interest point, and it is the smallest possible price movement of a currency pair. For example, right here, you have 1.28536, and here's how you count a pip. So ignore the 1 and the dot. Now you're going to look at the 2, 8, 5, 3, 6. Those 5 numbers. Now the 2 basically equals to 1,000 pips. 8 equals to 100 pips. 5 equals to 10 pips. 3 equals to 1 pip. 6 equals to 0.1 pip. That's how you count your pips. You see, you'll see them there on the side of the chart there. You'll see them there on the side of the chart, and then that's how you count your pips. Those are called pips. And then the second trading concept that you're going to have a look at is your spread. Now, a spread is the difference between the bid and the ask prices. In other words, the difference between the price at which you can buy or the price at which you can sell the price of a currency pair. Now, here's how you calculate spread. So basically, you'll have spread equals to your quote currency minus your base currency, which equals to 2 pips. That makes sense. Then the next trading concept that we're going to have a look at is your margins. Now, a margin is the minimum amount of funds that you must deposit into your account to open or maintain a position. So basically, you have your deposit and then you have your buying power. So the amount of money that you put in will depend, the leverage, it will allow you to have a certain amount of buying power. The leverage that you choose, say 1 to 100, that's the leverage that you choose. Now the amount of money that you choose, say it is 20 Rand, or let's say, okay, let's do this. Your leverage is 1,000 to 1, and then your deposit is 20 Rand. Now your buying power will be 20,000 Rand, basically. So I don't know how else to explain margins, but that's just the way that I understand it, and that's the way I've written it down for you guys in my notes. The next trading concept that we're going to have a look at is your leverage. Leverage allows you to trade with a larger amount of capital than you would normally be able to. It is expressed as a multiple. For example, 10 is to 1, 20 is to 1, 100 is to 1, 500 is to 1, 1,000 is to 1. So basically you'll have your required margin, which is 20 Rand or $20. Then you'll have your margin, which is $20,000 or 20,000 Rand. And then your leverage will determine the margin. Your leverage determines the margin. Remember, your required margin is 20 Rand or maybe 200 Rand or whatever amount it is that you have. And your leverage will determine the amount of margin that you get. In this case, you have $20, 20 Rand, and your margin will equal to $20,000 or 20,000 Rand. Now, the next trading concept that I want us to have a look at is a free margin. Now, free margin is the difference between your account balance and the amount of margin required to maintain your position. As a general rule, the more leverage used, the less free margin you will have in your account. Now, how do we calculate free margin? So first of all, here you have your free margin, which is, we're gonna start with equity. Equity is the amount of money that you have, and then your use margin is the margin. We just talked about margins. We talked about margins now. Yeah, we did. So you understand what margin is. I'm not going to explain it again because guys, it's a lot. So equity subtract used margin, which will equal to your free margin, which is $600. Hope that makes sense. If you don't understand, please go Google it. Go look at YouTube videos. I'm basically just explaining what I've gained so far. So the next trading concept that we're going to have a look at is take profit and your stop loss. Now, take profit is the price point at which you decide the price of an instrument has moved in a favorable way and you want to take your profit. As you can see here on the chart that I've drawn for you guys here, this chart, you can see my take profit and you can see my stop loss. I don't think I didn't put in a buy point, but yeah, nonetheless, you see the take profit and the stop loss. Now, I've just explained to you what is a stop loss. Now I want to explain to you what is a take profit. Now I want to explain to you what is a stop loss. Now, when you set a stop loss, you are telling the trading platform that it must automatically sell an instrument when it reaches a certain price. You set a stop loss to minimize your losses should the market move against you. If the market moves against you, that's when you set a stop loss. Now, I hear people saying November stop loss or something like that. And as a beginner trader, I wouldn't advise you do that. Use your stop loss, use your take profit, because the market is very volatile. Currency pairs, especially indices, US 30, US Tech, SPX 500, also known as US 500, German 30 or German 40. It's now been called German 40. So be careful, guys. Be careful when you trade. Remember to put in your take profit and your stop losses. You'll see there once you put in a trade, or once you manually put in a trade, especially on MT4 or MT5, you'll see there it will show you to put in your take profit and your stop loss. I did it in the very first video. In the very first video, I believe I talked about it. Maybe I didn't, but nonetheless, this is what it looks like. So yeah. Now the next trading concept is a lot size. In Forex, a lot defines the trade size or the number of currency units to be bought or sold in a trade. One standard lot is 1,000. It's 100,000 units of the base currency. Most brokers also allow trading with fractional lot sizes down to 0.01, sometimes even less. The fractional lot sizes are categorized as mini lots, standard lots, micro lots, and nano lots. So you can see there, you can pause and then you can look at what a standard lot size look like and the amount of units, a mini lot size and the amount of units, micro lot size and the amount of units, nano lot size, which you don't specifically use, but I think a few brokers, they will accept it. But nonetheless, the brokers that I use, they don't allow us to have a nano lot size. So yeah, these are lot sizes. And then the next trading concept that I want us to have a look at is a chart. Now, a chart is a graphical representation of the price movement of an instrument over time. Price bars are presented on the x-axis. No, that's the date. Here's the date. Oh, these are the dates. Okay, these are this is your x-axis, then this is your y-axis. Please bear with me. I haven't done maths in a long time. I haven't drawn graphs in a long time, so it's a bit confusing. Your y-axis and your x-axis. Your x-axis basically shows the price bars presented, and then the y-axis presents the specific date and price. New bars appear at irregular intervals depending on the selected time frame. As you can see, my time frame there, I think it's 1 hour, and then the other ones, you can choose different time frames that you want, and then it will just be up to you which kind of time frame you want. But time frames, they will as you go higher, it will show you the price points and the different kinds of candles that you will see. Now I'm jumping into my next trading concept, which is candlesticks. Candlesticks is a type of price bar that shows the closing price and highs or lows and opening prices for a given time period. Candlesticks are shown as vertical rectangles, like these ones, with a hollow or filled portion representing the range between open and close. So if the candle is going up, you can color code it as green. If the candle is going down, you can color code it as red. So green will basically be your bull, and your red candlestick will be your bear candlestick. So sometimes you can see when you look at your trend lines, you can set up trend lines, and then you see the chart, it's going up and down, but you can see a bullish trend line, you see, but sometimes you can see a bearish trend line. So you'll just see it goes down, or sometimes it goes up. That's a bullish. When it goes up like this, it's a bullish. When it goes down like this, it's a bearish. So you see, I hope that makes sense, guys. It's yeah. So what is support and resistance? Well, support and resistance is the level at which an instrument has had a significant price movement upwards or downwards. Now, at the top here, you have resistance, at the top. That's resistance. Resistance levels are areas where the prices stopped rising. They stop there. I can't go higher. Now I have to go down. It's resisting. And rising, where prices stopped rising for some time and were difficult to break through. So it couldn't break through, so it was forced to resist and go down. It's forced to resist and go down. And then the support levels, this one at the bottom. Support levels are areas where the market tended to reverse its trend and resume its previous direction. So basically, resistance is this one. I can't go any higher. Now I have to go down. Now support is when the market reverses. The market now, it reverses and it goes into a bullish trend line. This is your bearish, this is your bullish, and then this here is your support. Now in some cases you'll see it will look like this. Here at the top it is your resistance, and the market or the candlesticks, they don't go any higher than this point. That is your resistance. It resisted and now it's going down. So I hope that makes sense. Then the last trading concept that we should look at. This is very important for trading. You can't just head in and say, I'm gonna trade this, I'm gonna trade this currency pair. You need to know the different times and the different sessions that you're allowed to trade, the different types of sessions, the major markets, and your earliest, and I don't know what is EST, guys. You can Google that for yourself, UTC and GMT as well. So here you have your trading sessions. A trading session refers to the active trading hours of an asset or given locale. Usually different markets flow different trading sessions like this. So here you have your different trading sessions. You have Asian session, European session, US session, and the Pacific session. Your major markets in Asia is Tokyo, in Europe is London, in the United States it's New York, in the Pacific it's Sydney. And then you get the different times, the UTC and the GMT. Asian, Tokyo, 12 o'clock to 9 a.m. European, London is 8 o'clock to 5 p.m. This is South African. And then the US in New York, 1 o'clock to 10 o'clock at night. And then Pacific is Sydney, 10 o'clock at night to 6 a.m. in the morning, which is the next day. And then EST, Asian is 7 o'clock in the evening to 4 o'clock the next day, 4 a.m. And then EU London is 3 a.m. to 12 o'clock. So it's basically 3 all the way to 12. And then US, New York, is 8 o'clock, which is 8 a.m. 8 a.m. Yeah, I'm sure I'm right. 8 a.m. in the morning, all the way to 5 o'clock in the afternoon. And then Pacific Sydney is 5 o'clock in the afternoon, all the way to 1 a.m. into the next day, 1 a.m. in the morning. So those are the trading concepts that I'd just like to share with you guys, the ones that I've learned so far. And thank you very much for watching this video. Please don't forget to subscribe, like the video, share the link, and comment. Ekse Shap Fede.
I'm a Forex trader, please don't ask me what my G's at. I'm a Forex trader, I'm a Forex trader, I'm a Forex trader, yeah.